Welcome to this session on understanding what is financial management. Let's take with an example. Let's assume you are going to start a business. When you start a business, you should have an idea. You should decide what are the assets you require. Then you should be in a position to estimate what is the total cost of those assets. So only if you have these two, you'll be able to start your business. That is, you should know what are the assets required, then the cost. But this alone is not sufficient. You have to run your business on a daily basis. Then you should know what is the cash that is required to run the business. So now you have a fair idea about the cash that is required for starting a business and running a business. Then what you should do, you should identify sources. That is, sources have to be tapped for funding your business, for funding your assets, and funding the cash required to run the business. These sources can be from the owner's pockets, it can be owner's funds, or it can be from outsiders. So whether you raise the money from owner's pockets or outsiders, what you have to ensure is the cost of these funds are as low as possible. Only then the profits of the business can be maximized. So we can say financial management is mainly concerned with financing your business, arranging funds so that those funds can be allocated effectively for fixed assets creation, for running your business. So we call it as working capital, and all these are done with an intention to maximize the profit for the owners. So we can say financial management is concerned with financing decisions, then allocation decisions, and profit distribution. So we call it as dividend decisions. Okay. So to put it in a nutshell, financial management is concerned with financing, allocation of funds, and dividend decisions. In the previous session, we have understood that financial management basically focuses on sourcing of funds, utilization of funds, and dividend decision. So in this session, let's understand what are sources of funds, like what are the channels from which we can raise funds. Let's see one by one. For business, funds can be acquired from various sources. You can raise funds from debentures by issuing an instrument called debenture. If you're a public sector unit, you can raise funds by issuing bonds. Then you have your own sources. You can raise from the pockets of equity shareholders, the owners. Then you can approach banks for loan. It can be a short-term loan or it can be a long-term loan. Then there are venture capital investors. Okay, so they'll be interested in investing in your business if you have viability. Then we also have a different form of financing, that is hire purchase and leasing, where the ownership is going to be transferred to you on installments. Then there is something called angel financing. Okay, so there are various ways in which business can be funded. Okay, you can acquire you can acquire funds for business from these various sources. So now what we'll do, we'll just focus on what is equity, debenture, bank debts, and international funds. So to start with, let's understand the importance of equity as a source of fund. If you look at the equity funds from the risk point of view, I should say it is the best option, because as far as the equity funds are concerned, you don't have any pressure to repay that except when the company is under the liquidation. Okay, so from risk point of view, equity funds are best because it does not carry risk as far as the company is concerned, because there is no pressure to repay that fund except when the company is under liquidation. But if you look at it from the cost point of view, equity funds are considered as most expensive, because if you want to pay any return to the equity shareholders, that is dividend, then it has to be paid on the profits which are available after tax. Okay, so it is the costliest, and equity shareholders are taking huge risk in investing in your company, so they are going to expect higher return. They could have gone for a risk-free investments like investing in bank deposit, but instead of doing that, they are coming and investing in your company, so obviously they are going to expect more. So from cost point of view, equity is most expensive. And companies also sometimes will not prefer to issue or go for more and more equity, because whenever they go for new issue, it will result in dilution of control, which the companies does not want to happen. Okay, so this is the broader picture of equity. Let us understand something about debenture or say debts. As far as the debts are concerned, if you look at it from cost point of view, they are the cheapest. The reason is, unlike equity shareholders, the debenture holders are going to be secured, number one, and the repayment is going to happen as per terms. So their interest is taken care. And moreover, for a company, the interest that is paid on debenture or debts is an expense, and it will entitle the company tax benefits. So this feature is going to be a major attraction point for debts. But if you look at it from risk point of view, the debenture funds are considered as highly risky, because you have to pay the interest, you have to repay the principal as per repayment terms. So you have to repay them even when you are facing hard times. When your business does not make profit, when you suffer loss, you have to pay. So profit is not the criteria for debenture or debts. Okay, repayment terms is the criteria, and you have to pay according to the terms. And if that is not going to happen, then it will have its own consequences. The third channel available is funding by banks. See, banks, apart from their routine banking services, they also carry out lending services. They provide, or they carry out lending in two forms: one fund based, the other one is non fund based. In fund based, there will be a physical transfer of cash under loan account, and that can be in the form of cash credit or overdraft, or it can be a term loans, or it can be bills purchase or discounting. So each and every product has their own features that we'll of course see gradually in the course. Then there are some non-fund based facilities like guarantees, letters of credit. Okay, so these are all the ways by which the banks will do the funding. Then we also have international funding. If you take international funding, the foreign direct investments and foreign institutional investors are the major source for international funding. Apart from that, we also have this ADRs and GDRs. Okay, and they also bring in a lot of international funds.